We'll take stock of all the mid-cap movers, later on in the show. But, let me bring on board our first guest for today then, without any delay. Sandip Agarwal, Fund Manager, Sowilo Investment Managers, joining in this morning. Sandeep, great to have you on the show. A lot of good news has been sold into. We started September on a great note, unusually strong. It was going unusually strong for the market in the month of September, but then all the tariff tantrums started once again. IT, pharma, yesterday, films and wooden furniture, etc. So, tariff tantrums continue to weigh in on sentiment. But here on, do you see any positive trigger that may at least turn the tide for a bit? Because earnings wise as well, markets have got a whiff that second quarter may not be all that great. What do you feel?
Yeah, hi, good afternoon, and thanks for having me on the show. There are two things which market hits most. One is that, when the earnings downgrade cycle starts, and second is when there is uncertainty. Right now, earnings downgrade cycle, I think broadly is over. But, uncertainty has jumped up quite a bit because of this tariff and everyday new news coming. So all barriers have been actually breached. So basically, there was a view that the tariffs are applicable to goods, but slowly we have seen that indirect way of hurting even services has started. So I think because of uncertainty, market are not able to hold up and they are not able to sustain and go up. But this is the typical market where it makes bottom because they are not falling either in a big way. Yes, there are some stress points in some pockets. That's true. But I believe the reforms which government has done, right from income tax exemption limits and the GST reforms which has happened, these are very long-term growth drivers, and they will definitely push up the economy, give more money in the hands of the people, and it will be a structural, uptick for sure. But at the same time, because of the uncertainty coming from external markets outside India, I think people are not able to commit, and FI sales is not stopping. Another thing is that we have to remember that the green shoot is very clear that not only this reform, but the Indian market has massively underperformed the emerging markets, and that reversal will definitely happen at some point of time. So I think from here, limited downside, some time correction is possible, but I don't see a big downside. And I honestly believe that with earnings season coming in, while numbers may not be great, which is already discounted, but the commentary looks very robust. The capacity utilizations are at peak. So you will also see a big positive on the private capex coming back. So we are very, very positive and constructive on the market from a longer term perspective.
All right, very positive, constructive on the market from the longer term perspective. But what would you really do? Because today it's the end of the first half, it marks the end of the quarter as well. Time for portfolio cleaning, so to say. A lot of people do that. So, if one has to recalibrate their portfolios, what would be the place to look at now in this market?
So we have a very clear view that the next decade belongs to manufacturing because continuously the capex which is happening, the machining part of that is consistently becoming lesser and lesser. More and more ancillary products and machine parts are being made in India. So we are very, very positive from next decade perspective on the capital goods, particularly companies which are making small ancillary parts and forms part of capex for the industry. Second, we are very positive on the water theme, and third, we are very, very positive on the platform theme and some portions of pharma. So these are our preferred bets. What we don't like is primarily the FMCG and the technology software services side. These two spaces we are avoiding. We have some preferences within the banking, but not again very big because we would like to play them the banking theme also through capex theme.
Okay, got your point. You said that you're not very bullish on FMCG. So how do you play the theme of GST cuts? Consumption. It will of course spur demand, and consumption will benefit. So which end of the spectrum would you look at when you talk about consumption, if not FMCG, discretionary, and which other pockets? It's a wide universe.
So, the way we look at it is that whenever the per capita income goes up, right, at different slabs, then the incremental increase in per capita income, a substantial portion of that goes in upgrading of the products and the lifestyles. So we are very positive from long-term perspective to play things which are very expensive, like expensive car dealerships, expensive watch dealerships. All these things we are very positive, and the market size of them is very big. And see, FMCG we have already seen last 5, 7, 10 years because of falling fertility rates, falling population growth rate. The volume growth has been minuscule. Whatever 5, 6, 7% growth is coming is because of continuous price hikes, which is also impact of lower grammage. So we are not very keen on that theme. I think our markets are saturated from FMCG. FMCG is now not that buy at any price kind of strategy. So we are now looking for where the incremental money comes and how much allocation it gets. So that place we are very very bullish on the very life cycle upgrade products, very expensive products which reflects the higher per capita income. We want to buy something which deals with expensive watches. We want to buy something which deals with expensive cars. So everything which is expensive and making up the value chain, we would like to be part of that theme rather than buying the traditional, the FMCG companies
Okay.
which are the consuming side.
Okay, so premiumization, so to say. So where does auto fit in? We've already seen a large part of the rally play out for some of these auto names, especially the likes of Maruti, Hyundai, etc. Now, of course, under a bout of profit taking. But how much of the GST driven benefits are already in the price when it comes to autos? Of course, we are expecting September sales to be better. Mixed picture because of course we had the Shraddh season, and then we had the GST cuts kicking in from the 22nd of September. So whatever up move that we've seen in the auto pack till now, how much of the GST benefits are already in the price according to you?
So I honestly believe that a large portion of those benefits are already in the price. So if you see two-wheeler, probably will go back to 2019 numbers again now. So it has taken 5, 6 years to even reach that high which we made. So it takes time, and I think a lot of these benefits are already there. But let me put it this way: that these cuts, if they are passed to the consumers in longer term, they will definitely trigger much higher spend going forward also. And the if the industry growth rate was, let's say, X percentage, I definitely believe that on a structural basis for next 3 to 5 years, that will be X plus 2%. But unfortunately, fortunately, the stocks are priced in all of that also as well. So we like the sector. We believe there is some upside, but there is no big upside from here, in my opinion. Everything on the stock price has been already upfronted.
Okay. Most of it has been upfronted. Of course, tomorrow is the RBI policy, Sandeep. What are your expectations? What would the market be hoping for? Because the street is fairly divided in terms of the expectations. Some believe 25 basis point rate cut should come by. Some say that perhaps a pause is warranted. Which camp are you in? And from a market standpoint, if at all there is no rate cut, what would you look out for in the RBI governor's language or tone, so to say?
So, I am in the camp which believes that when you have to restart something, you have to upfront everything. And we were in the same camp when, RBI cut 75 basis point also. We believe that it will be very aggressive cut. I still believe that tomorrow also we will see cut because, see, we have to give cut because the inflation numbers, if you go into deep, you exclude gold and few of the commodities, then the inflation numbers are not so high. So there is a definite scope for cutting down more interest rate from here and give a booster to the economy when it needs most. So, government has done a lot on the GST side, income tax side. RBI has done a substantial amount of cut, and one more cut I don't think changes anything. Only thing is, we don't know what is the tolerance limit for the INR for RBI, where it wants it to be. Ideally, in the current situation, they should not control the INR too much. They should let it slide a little bit more because, it will indirectly, help some to absorb some of the tariff impact which is there. So I believe that RBI will definitely upfront the cut, and we are in the camp which believes 25 basis point cut should come.
Okay, 25 basis points should come. But, looking at banking as a universe, you said you'll play banking from a manufacturer standpoint. But, looking at the PSU end of the spectrum, they've done fairly well, in a weak market as well. Quite a few factors at play. Margin wise, a lot of experts say they are better placed versus private peers. They have lower EBLR loans, right? And secondly, the proposal to hike foreign limit in some of these in the PSU banking lot, that of course will come as a big boost as well. So in light of all this, how are you looking at PSU banks in particular?
So PSU banks are honestly looking very attractive right now because valuations are very low, and as you rightly mentioned, we are not going to see any shocks on the asset quality also, because most of the anything what can come negative had been taken into account. There has been provisions and everything. So we believe there is definitely some upside in the PSU pack in near term. But as a policy, we are little cautious not to go all in the PSU side, because there are many things which are into play. There is some OFS always lined up, or maybe can come some kind of divestment can happen. So we are little conscious about that. So we do buy one or two PSU banks which we like the most, where there is deep value. But at the same time, we fill our BFSI with more of NBFCs and some of the other private banks.
Okay, got your point. And I can't not ask you a question about IT. Of course, you guys are not very bullish on IT. Understandable, given the fact that we've seen visa curbs come by. But what is the kind of margin impact that you are factoring in as a result of these visa curbs? They are a one-time charge, right? So does that allay some bit of concern? And in terms of revenue, the top line, do you think that also gets hit? How are you looking at IT in light of the recent news? And of course, there has already been a ton of bad news. So would you still say that most of them has now been priced in? How are you looking at this whole space in particular?
So see, our money is fungible, and from that perspective, we don't have any compulsion to be in tech sector, to be honest. And that is the reason we have been negative for last 12 months now. We don't have much of tech, very small portions of very small tech companies, which we have bought for different reasons. But otherwise, we have exited most of our tech almost a year back, and we made very good money in the previous year. The reason is simple, that we don't go by what is the growth rate and what is the multiple. So this argument that the large caps are at 18-20 times forward earnings and all, we don't honestly believe that argument, because those multiples has to be seen in terms of PEG ratio, and at PEG ratio they are all at 4 times. So why should we buy services company which will grow at 3-4% with PEG ratios of 5, and then there are always a hanging sword of some or other challenges they would face, either from H1B or something else comes in. So we have no compulsion, and that's the reason we believe that the large cap IT doesn't make any sense. Similarly, mid cap ITs, they are trading at 5-6 times PEG ratio. We are not at all interested in them. And we do have little bit of small tech companies, very small ones, where PEG ratios are reasonable. They are doing good work, and the reason is very simple. Prior to 2019, it was all technology transition. The preferred vendor was large names, because the size of the deals were upwards of $200 million. After COVID, because of digital and quick execution, the deal sizes fell to 50, 25, $10 million. So biggest beneficiaries were the mid cap, which is like Mindtree, LTI, KPIT, which went up 10 times in just 12 months time, 18 months time. And this wave of AI, I think the deal sizes have further fallen to less than $5 million, $2 million. And the biggest beneficiary will be the small size companies, which can quickly do the work and give back. So I think, this is the time when small cap tech will do better than the mid cap, and mid cap probably will do slightly better than the large cap. But given the PEG ratios, we are not interested in either the large or the mid cap at all.
Okay, that's the view on IT really. But then how do Indian investors play the AI theme? Globally, of course, US, China, Taiwan, these are dominating. For us, we barely have any enablers. So, if an Indian investor has to ride this theme, should they do it via the indirect data center themes like NetWeb? I'm sure you won't be talking about stocks, but I'm just mentioning them. Stocks like Anantraj, NetWeb, these are some of the indirect plays, the data center plays, so to say. Should one look at these to ride this AI theme?
So, I have a very different view, and I'm telling you, after 25 years of my tech experience, I have run an AI company in 2008, so I can tell you from that experience also. See, the problem is that we are expecting Lata Mangeshkar to play cricket and Sachin Tendulkar to sing song. That is not right. Our economy is 140 crore people. Our strength is, consumer technology. And we will see Mat 7 size companies in next 10, 12 years from India in this space, that is in consumer tech. Why we need to have necessarily be on the AI side? See, people have to see data, go in history and see the data. You check Microsoft listed in 1986 at 750 million market cap. At that time, US economy was $5 trillion. We are not there yet. So how can you expect that enterprise software, enterprise operating system, all these companies can come and become $1 trillion in next 5 years? It is not possible. Our economy, when it becomes $5-7 trillion, then first of those such companies will come. But I still believe our consumer tech, whether it is urban company, whether it is Zomato, whether it is Swiggy, all these companies we have holding in some of them. So all the disclaimers in place. I'm not recommending any of them, but I think consumer tech is the big tech
Sure.
for us, and we should look at them very positively and think what is the strength. So this 140 crore population is the strength. This 140 crore consumer tech is the strength. We should not try to find AI in India. That is, not everyone cannot do everything, right? We are already good in autos. We are already good in
Sure.
software services. We are good in pharma. Now we want AI to be also to be very good. We can be good in consumer tech, which we are superb. I can tell you that much.
So I think we should also tell the FIIs this, because they are not finding any AI plays here in India, which is why they are going to other nations like China, Taiwan, and which is why I think some of this underperformance, in terms of the emerging market peers can be attributed to. But nevertheless, you're right. Of course, consumer tech, that's the way forward for us here in India. But with that, Sandeep, would like to thank you for taking out time and joining in this afternoon. Always a pleasure, and I look forward to our next conversation as well pretty soon.
Thank you so
And
much.
of course, wish you a very happy Navratri and festive season as well.
Thank you, same to you. Thank you.
Thanks a lot. Well, Sandip Sowilo with his thoughts on the market and the sectors that are looking good and the sectors that are not looking all that great at the current juncture. Shifting focus to